So, we are coming to the most important and most appealing and most demanding topic in our curriculum, and this is the risk management part. And as I spoke to many students, that is what they seem to have been interested in, and they wanted to practice more questions. Also, they wanted me to get into some theoretical aspects of it. This particular area is little challenging, and it has been of an immense use from the examiner's viewpoint. It has been frequently tested. The risk management part will be discussed basically in two aspects: risk management we need to manage the exchange rate risk. Exchange rate risk. We also need to manage interest rate risk. Interest rate risk. Right. I am just thinking of getting into more detailed theoretical discussions. Why? Without knowing the theory, sometimes if you take examples like future contracts and options, and without you knowing even the forward contracts, if you do not know the theory well, doing some questions will be hard. And this is, a practical aspect of it. It's not like doing assumptions and doing the calculations like business valuations. This is something which is happening in practice. So, whether we like or not, then we need to know it. So, I just thought of making this little detailed and to discuss some theory part first, and then to start doing some practicing questions. So, both are equally important. And let me isolate this word risk. We'll isolate it from the others, interest rate and the exchange rate risk. Let me isolate the word risk. And we talk about risk in many areas in our curriculum. It can be the business risk, it can be sometimes financial risk, it can be sometimes credit risk, and we talked about business risk in the risk and return topic, and then we talked about credit risk in bond valuations. Of course, bond valuations are yet to be done in our discussion. Here, what kind of a risk are we going to talk about? It's not a particular risk, it's not a specific risk in particular. In general, what do you mean by the risk? The risk of anything can be the chances of actuals being different from your expectation. The risk can be anything where your actual realizations will be different from your expectations. If you think of working in a government organization, and if you will be promised a salary of 1 million rupees a month, many people prefer to work in government organizations because what they say is the risk is low. The people who live right across the world will be full of doom and gloom, but still the people who live in government organizations will be full of happy because whatever happens in the world, they will not stop receiving their salaries, not even a single cent of reductions, and they do not have any possibilities of, compared to the others, losing their actual cash flows from their expectation. Now, if you make an investment in government bonds, the risk is zero. We have never heard of any government all over the world defaulting the payment of interest and payment of capital, but the return is also comparatively low. And if you make an investment elsewhere, where the return can be comparatively high, at the same time we also take over a risk of our actual realizable amounts of our return, and sometimes the actual realizations of the capital can be a little lower than our expectations, and then there will be a risk. And if you are perfect technically in that subject, and if you expect 100 marks at the exam, if you get 100 marks, if you know for sure you will get 100 marks, and there is no risk. And if you expect to get 80 marks, and if the actual marks will be 60, there will be some kind of a risk. Because there are certain areas which you haven't learned properly, but you kept praying to the goat, and I don't think the goat will help you at the exam, because you need to help yourself. The goat can't help you, so you need to work hard. And then if you haven't done certain topics thoroughly, and if that was the very area where the questions have been set from, of course you have a risk, because actual results will be little lower than your expectations. And people have the habit of doing selective learning. I know some of you all may not watch all the videos. You select and watch. Or maybe sometimes while watching videos, you will fast forward sometimes. That is not timber. You make your own judgments. And then sometimes the questions will be set from the areas which you thought was not so important. And your actual marks, actual results will be lower than your expectations. So there can be a risk. So by and large, without being specific to anything in particular, what do you mean by the risk? The risk is the chances of the actuals being lower than your expectations. Then you might say, if the actuals will be higher than the expectations, there is no risk. There is a risk, because the life is like a roller coaster. There can be ups and downs. If always the actuals will be higher than the expectations, this is not going to be the world where you and I live, and this is going to be something like the heaven. The actuals being higher than the expectations will indicate the fact that it will be turning around, and there can be, it's moving to the other direction as well, and there can be a lower, there is a chance of the actuals being lower as well. So the actuals being higher than the expectations also will indicate there will be chances of the actuals being lower as well. So that is what it is all about, the risk is. Now we know every business organization, especially in Sri Lanka, they cannot operate alone. If you look at the nature of the economy of Sri Lanka, we all are dependent on foreign countries. Hardly can we find a company who does not depend on foreign companies. I mean, if you have a manufacturing process where you buy all the materials from the local channels, and you take all the goods to the Sri Lankan local market, and then you don't have a risk at all, because all your materials will be settled in the local currency. All the materials will be settled for in local currency, and all your revenue will be denominated in local currencies, and you are not exposed to the foreign currency transactions. But most of the trading organizations that operate in the country do the trading not by manufacturing on their own, they do the trading by importing goods from other countries. And most of the manufacturing companies that operate in Sri Lanka are export oriented. They know for them to get a better price, they should not take that to the local market, and they always try to export that to foreign countries. So almost all the businesses that operate within the Sri Lankan territory do not operate alone, and they are connected with the foreign community. They are linked with the foreign customers, foreign suppliers. The more and more they are linked and connected with the foreign suppliers and the foreign customers, more and more they will be exposed to the exchange rate differences. So as a result, you have a risk. Why? The fluctuations of the exchange rates will make your future returns variable. So what is temperamental is temperamental, and you and I can't stop that from happening. Then if you expect 1 million rupees worth of a profit just in 1 month's time, and depending on the fluctuations of the exchange rate, your return actual cash flows will be different, isn't it? Yes, it will be different. What if you decide to import a 1 unit of material at $1 when the exchange rate was 200? If the exchange rate is moving from 200 rupees to 220 like what we are experiencing now, your cash flows will be reduced by 20 rupees. So, these fluctuations of the exchange rates will have a direct impact on your return. In other words, the fluctuations of the exchange rates will make your actual returns, actual realizations of your returns variable, and sometimes that will even be worse by making your actual returns lower than your expectations. Of course, there is a risk. And by the time we exported one item to an overseas customer, the value of a dollar was 200 rupees. And we have given him 3 months credit term, and we expected him to pay that in 1 month's time, and we expected the rate to be at 200 by the time of receiving money from the customer, but unexpectedly it has fallen down to 180 rupees, and the rupee is now getting strengthened. All right, it's good in terms of the economic growth, but as far as we are concerned, we thought of receiving 200, now we are receiving only 180, so our actual returns will be lower than our expectations. So, this exchange rate fluctuations do have a direct impact on the returns, and the returns can be, moving up and down. The returns can be sometimes not the returns we expected at all. So, what will make our returns variable is not because of anything else, because of the exchange rate, and you need to know how to manage it right. And let me talk about interest rate risk little later, having completed first exchange rate risk. Right. Now, when you do something, there are certain risks. Those risks are inevitable. Those risks are unavoidable. Those risks are inherited. And those risks are embedded. If you want to take over a particular activity or a risk, a particular activity or a task, you need to take over that activity or the tasks along with the risks. Why? Those risks and the tasks are inseparable. Now, for an example, if you think of being a pilot, the pilot will take over the risk of losing the life in the event of an aircraft crash. So, the pilot dream of being a pilot one fine day by taking over the risk of dying and losing and giving up the life in case of a crash of an aircraft. The sky is so high, you and I can't fly, but a pilot can fly depending on the condition of being ready to accept and take over that particular risk. Can you ever think of being a pilot without taking that risk? Without taking that risk? No. For you to be a pilot, you must be ready and you must be prepared to take over that risk. And as long as you are prepared and ready to take over that risk, you can be a pilot and you can make more money. You can earn a lot. Now, the certain risks that we take over in running a business or doing whatever the activity are avoidable. If it is avoidable, no point of talking about it. Why? You can avoid it. So, you start doing something and you identified what the risks are, and if the risks can be avoided from, you need not to think of it, you need not to speak about it. Why? Because you can avoid it. But if there are certain risks which cannot be avoided from, they are inherited into that particular business activity, you need to think of strategies, you need to think of ways and means of minimizing risks, and that is what we are going to talk about in these discussions. The type of risks that can be avoided from are not worth being spoken about. The type of risks that are worth being spoken about are the type of risks that cannot be avoided. If it is not avoided from, you need to strategize in your business in such a way that those unavoidable risks can be minimized. Now these unavoidable risks should be either mitigated or should be diversified. Just for the purpose of minimizing the effect from the risks, what we can do is either you can develop strategies in the business to mitigate the risks for the sake of minimizing the effect to the business from that risk, or else you can think of diversifying that particular business activity or whatever the activities you have taken over in such a way that the risks that we are going to take over can be spreaded among so many items, and then the effect on that can be minimized. And let me take a couple of examples how the risks can be mitigated and how the risks can be diversified. What do you mean by mitigating the risks? You will transfer the risks to another party or to another object. Now say for a simple example, if you are riding a motorcycle, you know how the motorcyclists are in Sri Lanka, especially how indisciplined they are on the road and how self-centered and selfish they are on the road. They think of only of themselves, no road rules, nothing. They are not worried and they do not damn care about anything else on the road, and they just think of only themselves. Everyone 100%. And the best part of it that is, I don't think anyone who rides a motorcycle has a head, but they wear a helmet. You know, motorcycle has only two wheels and we are sitting on two wheels. These two wheels keep turning always. And just in a fraction of a second, some accident can happen and that will overturn. If that overturns, the very first item and the body part that will be damaged will be the head. So just for the purpose of protecting the head, you will wear a helmet. By wearing the helmet, what do? We let that helmet to be broken and crushed into pieces, not the head. And the risks that will be, the risk of your head being damaged and being broken into pieces has been transferred to another object. Now, if somebody was knocked down on the middle of the road by another motorcyclist, and that the motorcycle has overturned and you fell, and then you understood the fact that as you got up, the helmet that you have been wearing has been broken into pieces, it has been powdered in, it has been crushed into powder, but your head has been safe. What have you done? Mitigated the risks. You have transferred your risks to another party, to another object, to another device, so you are safe. That is mitigating. Similarly, when you run a business, if you have kind of a risks, we will see what the risks are, and then we can strategize our business in such a way that our risks can be transferred to another party or to another instrument, and then we call it mitigation. Diversifying. And if you want to have some oily meal, like you prefer to have a biryani today for your lunch, and you know biryani is, you know, it's not that healthy, it's not such a healthy meal because it's so oily. But together with the biryani, you will think of eating a minchi sambar. What will happen is the impact or the effect of this oily food will be absorbed by the second item, which is the minchi sambal. So, you mix up your biryani together with the minchi sambal. So, the minchi sambal will engulf, will absorb the effect of oily element of your biryani, so that you will be safe. You spread it. And if you go for an insurance policy, the same thing happens. There will be lot of people in that insurance policy pool. So, you will pay into the pool and all the others will pay into the pool. And if you are safe, you will not be compensated, but your money will be used to compensate to the other people who would have suffered some losses. And the very simple example in risk and return and in portfolio management, what you do is, if you make investments in a company, if you make investments to buy the shares of a company that manufactures umbrellas, and you get the highest return from this investment only during the rainy season. The return that you get from this umbrella manufacturing company investment is not as much as the return you expected at the beginning. And if you get the highest possible rainfall right across the whole year without a break, and you can maximize your return. But we might get the highest rainfall in the country during the month of June and December. So, those are the months during which your return can be maximized. Then you, being wise, without being otherwise, decide to split your investment into two. You will decide to make investments partly in umbrella manufacturing company shares, and the balance part will be invested in sunglass manufacturing company shares, so that during the rainy season you get the highest possible return from umbrella manufacturing company, whereas the balance will be from the sunglass manufacturing companies. You are pretty well off now. What did you do? You have spreaded your risks. So, likewise, here there will be some risks that are avoidable. If it is avoidable, so why do you worry about it? And you need not to do anything about it. Absolutely nothing. Just keep quiet. But if there is a risk which is not avoidable, of course you need to take it over. Unless you are prepared to take it over, unless you are ready to face it, you cannot run a business, you can't do any damn thing. And then you need to, having taken over that, you need to think of strategies, you need to think of strategizing your business in such a way that those risks are either mitigated. What do you mean by mitigations? You need to transfer it to another party or to another object, or else you need to diversify in such a way that the impact of taking over the risks can be minimized. Exchange rate risk. Exchange rate risk. Now, hardly can we think of a business who will not be impacted by the exchange rate fluctuations in Sri Lanka, starting from a small scale business organization right up to multi-scaled and multinational, well diversified large scale business organizations. Almost everyone will be equally impacted and affected. If you think of a bank, they are highly impacted because they enter into direct foreign currency transactions. If you want to travel abroad, you need to buy travelers checks, you need to buy foreign currencies. They do buying and selling of currencies, and the currency fluctuations, exchange rate fluctuations do impact directly to people like banks. Hotels, and it is another business organizations which will be directly impacted from the changes of exchange rates. Why? We have our customers who will be mostly the foreign customers, and we do enter into transactions where the values are denominated in different currencies in different countries, so that the changes of the exchange rates do impact to our business. And if you are a manufacturer where the materials are taken down from foreign suppliers, once again the exchange rates will directly impact your business. If you are a manufacturer where the materials are taken from local channels, but all your products will be taken to the overseas market, once again the rates differences, the fluctuations of rates will directly impact into your business. And if you run a business like, say, importing and trading in Sri Lanka, once again it will be impacted. And even if you run a business which is not directly connected, which is not directly getting involved with the foreign community, will be indirectly impacted. So now we need to think of all these business organizations. Why? Because sometimes even if you buy everything from Sri Lanka, even if you take everything to the local market, you will decide to go for a foreign bank loan. So you will be exposed. And you will think of selling some assets to overseas buyers, you will be affected. And you will think of buying some assets from foreign suppliers, you will be affected. And you will think of giving a loan to someone outside the country, overseas party, and then again you will be affected. The courier companies will be directly affected, logistics companies will be directly affected. So you understand the gravity of the problem. Now, what kind of risks do we encounter in running a business? Now, in our discussions, we need to focus on two main aspects. What are these two main aspects? Before you decide how to strategize your business to minimize the risk, you need to identify the kind of risks. And without being able to identify the kind of risks that we are going to take over, you will not be able to think of strategies required to minimize the risks. So, ladies and gentlemen, first and foremost, slowly we'll pay the first attention to the kinds of risks that anyone has to take over, and having identified the kind of risks only then only we can think of strategies or ways and means of minimizing the risks. What are the risks that a business organization will face? It can be sometimes the transaction risk. Or it can be sometimes the translation risk. Or it can be sometimes economic risk. Right. It's not that hard. And let's identify the kind of risks in a business organizations in terms of the foreign currency transactions. And having identified and understood the kinds of risks, and then only you can think of developing your ways and means, developing strategies to minimize it. So without knowing what the risks are, you can't do any damn thing. Transaction risks. What do you mean by the transaction risks? Very simple. And let me take some simple example just to drive this straight to your head. And certain things these are not complicated, but as we progress, and you need to think of some advanced complicated examples, some calculations, and without knowing some theories, it's hard to push ourselves forward. So transaction risk is this. Now, a business organization will enter into a transaction with a foreign bank, and they have borrowed $100,000 when the exchange rate was 200. And it was 20 million rupees. In terms of local currency, it was 20 million. And this is to be settled just in 3 months' time. By the time of making the settlement, the rupee has been weakened further and the dollar has been strengthened. Now the rate is 220. So you can't just pay 20 million rupees and wash your hands, and you need to pay altogether 22 million rupees. At the time of borrowing, and you getting that converted into Sri Lankan rupee, that is your local currency, we received only 20 million rupees in the loan, but at the time of the settlement, the rate at which the settlement should be done is different from the rate at which the loan was received, and then you are losing altogether 2 million rupees. If you are losing 2 million rupees, you are losing, aren't you? You are losing, aren't you? If you are losing extra 2 million rupees, it affects to the return, doesn't it? It affects to the return, doesn't it? We expected, say, 4 million return. Unexpectedly, due to the rise and due to the weakening of the local currency Sri Lankan rupees, we had to spend additionally 2 million rupees. Actual return has been 2 million. We expected 4, we got only 2 million rupees. So what made you desperate? What made your return lower than the expected return? It's nothing but the change of the exchange rate. So this is called the transaction risk. The transaction risk arises when you settle in cash. If you took it today or 3 months back, and if you settled it today, at the time of you settling the bank loan, the rate has been 220, whereas the rate has been 200 at the time of borrowing money. The rate at which the settlement is done is different from the rate at which the loan was received. So this is going to be the transaction risk that relates always to a cash flow. Always to a cash flow. Transaction risk always refers to a cash flow. It arises at the time of the settlement. If your actual cash settlements is higher than the amount of the cash flows we received, let it to be the transaction risk. Let it to be the transaction risk. Translation risk. Translation risk. What do you mean by that? Very simple. Now, say company A is a local company and they acquired a foreign company, say company B, and we can call it a subsidiary company because these guys acquired the control over company B. And it was on 1st January 2020, and company B had total assets of 10,000. They had total assets of 10,000 and they had a share capital of 5,000 and they had reserves of 3,000 and they have total liabilities of 2,000. Now you know, to some extent you need to think of some financial reporting part here, LKS 21. Now that I am going to give you some examples of financial reporting, no, it has to be connected with this. On the acquisition date, 1st January 2020, company A, in addition to preparing its individual financial statements, also need to prepare consolidated financial statements combining A and B. Since company A has already adopted Sri Lankan rupees to have been their presentation currency, before the consolidation procedures, they need to translate the financial statements of this foreign company B from their own currencies to the presentation currency, which is Sri Lankan rupees. How do we do that? You need to multiply it by the rate. So let me take the rate as 100, please. On the acquisition date, 1st January 2020, the rate was 100. So it has to be how much? 1 million total assets. And this has to be 500,000 total assets. And it has to be 300,000 total assets. It has to be 200,000 total assets. Total assets 1 million. Equity plus liability is 1 million. Total capital 500. Total reserves 3. Total liabilities 200. Now, the rupee is now becoming stronger. The rupee is getting strengthened now. The rupee is now 80 rupees. As a result, your assets values should be 800,000 800,000. Share capital and the reserves do not change. You need to let them to be in the books at the same value. It has to be the translations of equity figures should be at the rate, at which they were originally translated on the acquisition date. So, share capital should be 500,000, reserves need to be 300,000, liabilities need to be retranslated at the updated rate of 80 rupees, it is 160. Now, the assets value is 800,000, equity plus liability should also be equal to 800,000, and there is a loss of how much? 160,000 loss. 160,000 loss. There is a translation loss of 160,000 rupees. Translation loss of 160,000. This loss arises not at the point of the settlement. Not that did we settle anything. Not that are we going to settle anything. But you translated your balance sheet 1 year back on the date of the acquisition, there was no loss. But as the rupee is getting strengthened gradually bit by bit, you kept retranslating your balance sheet and the financial statements of the foreign company. At the time of the translations, you had a loss of 160,000. This particular loss, the chances of this particular loss arising is called the translation risk. If this is not so clear for you all guys, you can have a very basic and a simple example. I took 100,000 loan and this was in dollars. The exchange rate was 100 rupees at the time of borrowing money, so that was 10 million rupees. 10 million rupees. And the lender has given us a grace term where we can stay without paying the loan over a couple of years' time. On the reporting date, the exchange rate has been 120. Now, you cannot let your loan to be in the books at just 10 million rupees. If you do that, we are violating some accounting standards. You need to revalue and restate it at how much? 12 million rupees. So, we are losing 2 million. It's not because we settled. By translating your monetary items at the current rates, a loss arises and this amount is different from the value which was translated originally at different rates. Now, these values are different because we used different rates for the translations, and the chance of losses arising is called translation risk. Third one, economic risk. What do you mean by economic risk is very important to understand. Say we are a manufacturing entity, also we are export-oriented company. All our exports will be invoiced to our customers in US dollars. And all our supplies, the materials will be invoiced to us by sterling because we get down all the required materials from UK. Now, on top of that, we have selected, for some reasons, we have chosen Sri Lankan rupees as our local currency, and that is the currency in which we prepare financial statements, rupees. Now, the rupee is appreciating against dollars. Dollar is depreciating and the rupee is now becoming strong and stronger gradually, that is getting strengthened. We exported some goods at the value of $10,000 and it was 200 rupees at the time of the export. But at the time of receiving money, it has come down to 150 rupees. So, we are losing 50 rupees out of every single dollar. On the other hand, the currency through which we pay for the materials is now becoming stronger against our local currency. rupee is depreciating against sterling, but rupee is appreciating against dollars. So now it was 200 rupees per sterling sometimes back at the time of importing materials. It has now become 220 rupees per sterling at the time of settling. So we are losing not only from exports, also we are losing from the imports. Now we are suffering not only from imports, we are suffering from imports as well. We are suffering from exports because dollar currency is now depreciating against Sri Lankan rupees. We are losing from imports because Sri Lankan rupees now depreciating against sterling currency. So this is a problem of your competitiveness in the market. This will result in not being able to sustain in the competitive market continuously. So this is called what? Economic risk. Economic risk. So this is what you need to find solutions for. You need to find solutions for the translation risks. You need to find remedies and healing for the transaction risks. And you need to find healing and remedies, strategies for economic risk. If not, your actual results will be lower than expectations and you will not be able to enjoy the expected return. Why? Always the actual returns will be much more lower than expected return. But if you try to minimize it, if you find some remedies for the translation risk, if you find some remedies to the transaction risk, if you find some remedies to the economic risks, the variability, the fluctuations and the risks, the variability, the vulnerability of your actual returns may not be as much as we expected them to have been. So you need to think of the strategies. What strategies can you think of in common to overcome, to get over the transaction risk, to get over the translation risk, to get over the economic risk? And we have many. I will keep listing them down and then we need to start discussing them one by one. So that's going to be a bit of a tiring exercise, but I thought of doing that little in detail before we started doing the questions on this, because it's worth being done. So without knowing the theory, no point of me doing the complicated calculations here and you do not know what the hell it is. Nobody knows head or tail. I'm just doing and keep shouting. So for that to be made little valuable for everyone, for that to be little useful to everyone, I just thought of doing some clarifications and doing certain explanations in theory and then to get on with the question. So what kind of strategies can you think of? Sometimes you can decide your invoice currency can be the local currency. We will not only decide to invoice our goods to our customers all over the world in local currency, also we will request our suppliers to invoice their goods to us in our local currency. We will go into details later. Or you can match receipts and payments. Receipts and payments can be matched. Receipts and payments can be matched. Or you can match assets and liabilities. Assets and liabilities can be matched. Assets and liabilities can be, I'm just keep listening the ways of diversifying or mitigating the risks here, and we'll start explaining one by one. And certain concepts are very simple and straightforward. We need not to spend more time and very basic calculation, but certain calculations will be little hard and you need to know them in nitty-gritty. Or it can be sometimes leads and lags. Leads and lags. Or it can be sometimes netting off. Netting off. Or it can be sometimes strategies like money market hedge. Money market hedge. Money market hedge. Or it can be sometimes A strategy like forward exchange contract, forward exchange contracts, or it can be a strategy like futures contracts, entering into currency future contracts, or it can be sometimes options on future contracts, options on future contracts, options on future contracts. So these topics can be little complicated: forward exchange rate agreements, future contracts, options on future contracts, even money market hedging can look little complicated unless you know it perfect. So you need to be thorough of all these concepts first, and then only we can think of going for examples and calculation. Why the examiner, especially the questions in my tut, are little complicated, because the examiner tries to test on overall basis. It's kind of a holistic assessment of the entire syllabus. He just does not ask a question from money market hedge. Maybe within the same questions do we get calculations relating to money market hedge, maybe futures, maybe options on futures, maybe forward, and then we are supposed to comment on the best solutions that will minimize the cost to the company and maximize the return. So for that to be done, you need to do almost all the calculations at a stretch, and then only you can come to the conclusion. So as a result, my effort is try to make it very simple, and to drive it straight to your mind, and then to go to the questions. Before we start discussing the strategies, I need to talk a little about the exchange rates. Exchange rates. Now, exchange rate in our simple language which you and I understand, the exchange rate has to be the rate at which the two currencies will be exchanged, or the number of currencies to be exchanged, the number of units of currencies to be exchanged for a given currency should be the exchange rate. And we mainly talk about two exchange rates. You would have heard enough about it before. One has to be the spot exchange rate, the other one is the forward exchange rate. A spot exchange rate and the forward exchange rate, spot and forward. The spot exchange rate is the rate which is available for immediate delivery. And if you want to buy $10,000, if you want to just buy $1, the rate at which $1 has to be purchased today, and you are supposed to pay, say, 200 rupees to buy one single dollar. For immediate deal, if the transaction to happen today, not in the future, if the transaction to happen today, what has to be the available rate? The rate which is available for immediate delivery has to be the spot rate. So it's not for tomorrow, it's not in 2 days, it's not in 1 week's time, it's as of now. If you want to exchange 200 rupees, how many dollars will be given to you? For immediate delivery, for immediate exchange of dollars, you are supposed to pay 200 rupees to anyone, to an exchanger, to a dealer, to a bank. What do you mean by the forward rate? You will enter into the transaction today and you will keep it blocked and fixed, but the delivery happens in the future. The forward exchange rate has to be the rate at which the delivery is to happen in the future. The delivery happens in the future, but you enter into the transaction today. And if you want to exchange $1 in 2 weeks' time, the rate can be a little different. If the rate now for immediate delivery is 200, maybe depending on the fluctuations, people can predict it to some extent. They might say, look, I need 210 rupees to exchange $1. I have to give 220 rupees to get $1, that is in 2 weeks time. I am just taking a simple example. Just to make it simple, if the rate is available for immediate delivery today or as of now, we are going to complete the transactions, at what rate you can exchange dollars and rupees, any currency in the world. So, you want to exchange it in the future, but you want to keep it blocked. You enter into the transaction today, but the delivery takes place in the future. So, at what rate can you exchange a dollar with rupees in the future? Now, very important to understand how these exchange rates are quoted in the world, how exchange rates are quoted in the world. And basically, we have two methods of quoting exchange rates. One is called the direct quotation. The second is the indirect quotation. And this is absolutely important in going forward. Why? You will get stuck sometimes without being able to understand how this quotation was done. And also we need to identify the buying rate and the selling rate. In identifying the buying rate and the selling rate, it's absolutely important to understand how the rates have been quoted. If a number of local currency is expressed to a unit of foreign currency, it is called direct quotation. If the number of local currencies will be expressed for just one single item of foreign currency, we call it what? Direct quotation. On the other hand, if the number of foreign currencies will be expressed for one unit of local currency, that is called indirect quotations. Now, we are very much familiar with the direct quotations. Why? And that is what we have been seen always in Sri Lanka. So, this is what you have seen wherever you go. If you want to go to airport, if you want to go to banks, and this is what everyone is used to display. $1 is equal to 100 rupees. Here what do? For one unit of foreign currency, we will express the number of local currencies. How many local currencies to be exchanged for one unit of foreign currency. Especially this happens even in Sri Lanka. It happens because if the local currency is very weaker compared to the other currency, you need to make use of this way. The other way, it will be very hard to understand. How many dollars to be given? It will be decimal points, even if you take it from the calculator, the way it is given in the calculator can be a little different. If the local currency is weaker against the foreign currency, so we need to express this way, the number of local currencies to be exchanged for one unit of foreign currency. This is the direct quotations, and this is what we are used to and we have been familiar with. And this is used all over the world. Second is what? Indirect quotation. If you declare the number of foreign currencies against one unit of local currency, and that is going to be what? Indirect quotations, even that is happening all over the world. Now let me take a simple example. Say we are now in a country like UK. So their local currency will be sterling. Local currency will be sterling. And we'll take a foreign currency like US dollars. So in deciding how the quotation has been done, you need to decide the local currency and you need to decide the foreign currency, especially in questions. As a result, the examiner has been very careful in expressing the company or the country where that particular company is located. If it is located in England, UK, the local currency has to be sterling. Then, if you say one sterling will be equal to $2 to US dollars. We are in UK, and for UK, United Kingdom, the local currency has to be sterling. The local currency is sterling. So number of foreign currencies will be expressed. For 1 unit of local currency, and this is the indirect quotations. Number of foreign currencies will be expressed for 1 unit of local currency. This is called what? Indirect quotation. And for you to get 1 sterling within UK, I mean in that particular country, you need to pay $2. And it can be expressed the other way. What is it? 1 US dollar is equal to 50 cents of sterling. We are now in the country United Kingdom, where the local currency is sterling. Now, number of local currencies will be expressed for 1 unit of foreign currency. Number of local currencies will be expressed for 1 unit of foreign currency. That has to be the direct quotations. So you need to find out first, in doing any questions of this category, the country where the particular company is, and you are working for a company. We will get a scenario relating to a company. You need to think of the company. You need to think of the country where that particular company is located. So based on that, you need to decide the local currency and foreign currency. And then you need to see how the quotation has been done. If the local currencies have been expressed, if the number of local currencies have been expressed for 1 unit of foreign currency, let it to be the direct quotations. If number of foreign currencies have been expressed for 1 unit of local currency, and let it to be the indirect quotations. So that understanding is very important, without which going forward will be little harder. And if number of foreign currencies are expressed for 1 unit of local currency, it is indirect quotations. If number of local currencies are expressed for 1 unit of foreign currency, let it to be the direct quotation. So we do not know in which method the questions will be set. Sometimes it can be direct, it can be indirect, and you need to get used to it. So we need to go forward, and then we know in deciding or in giving the currency rates of exchange, that is always given in a range. Now in Sri Lanka, say 1 US dollar is equal to, they would have given a range, 205 to 210, and that is bit of a big gap, so let it to be so. So this is direct quotations or indirect quotations. This is direct quotations. Why does it become direct quotations? Because the number of, it has to be injected into your body. So let it to circulate everywhere in your body with your muscles and the bones and your blood. If not, going forward with the questions will be harder. This has to be deep rooted in your mind. Please, I wish you can do it. Here, it has to be the direct quotations, number of foreign currencies to be exchanged for just 1 unit of currency of local. Why are the rates given in a range 205, 210? And most of the people who get involved in this foreign currency transactions it can be a currency dealer, currency broker, it can be a bank, it can be a hotel, and they are into another business of buying and selling currencies. From each and every single transactions, they have a profit motive and they want to make a profit. As much as you do the trading of commodities, of buying and selling commodities to make profits, even the banks and the hotels and the brokers, the dealers are also in this business of doing buying and selling of currencies. So they buy at one rate and sell at a different rate and they make profit. So we know as a practice, as a rule of thumb, the rate at which the currencies need to be sold should be higher than the rate at which the currencies are purchased. Not necessarily always. It can happen the other way around. It can happen the other way around. What the selling rate has to be and what the buying rate has to be should be decided based on how the quotations have been expressed. Okay, so that has to be carefully understood. If you mess that up, everything will be messed up, and let me take this to explain. Now this is the direct quotations where number of local currencies are expressed for 1 unit of foreign currency. In a direct quotation, selling rate has to be always the higher rate. Selling rate has to be higher. Selling rate is higher. And buying rate should be lower. Buying rate should be lower. Not that do I expect you to memorize it, but you can think on your own and let your brain to work faster. Now, if you need to think always from the bank's viewpoint, not from the buyer's viewpoint. I mean, not from the company's viewpoint. If you work for a company, don't look at it from the company's viewpoint. You need to always look at it from the bank's viewpoint. And based on the bank's buying and selling only, we will be able to enter into the transactions. Whatever the rate that the bank offers has to be the rate at which we need to buy. Whatever the rate at which the bank is offering has to be the rate at which we should sell. So it's not we who decide, the bank is deciding the rate, whether you like or not. You need to enter into the foreign currency transactions at the rate specified by the bank. Specified by the bank. Now, if this is because the bank is running a business, the bank is into another business of maximizing their profits. If they give you $1, this is the bank and you are the customer, you work for a company, your company has been the customer of the bank. And if the bank is giving you a single $1, you need to give the bank the rupees. How many rupees does the bank accept? It is 210. 210. On the other hand, you are the customer and the bank is now taking $1 from you. The bank is taking $1 from you. You give $1 to the bank, $1. The bank is now giving you only 205 rupees. Now, the bank gave you the $1 at 210. So the bank has collected 210 rupees in giving you the $1. And if you return the $1 back to the bank will return you only 205 rupees. So the bank has made a profit of 5. For the bank to make a profit of 5 rupee, the selling rate has to be higher and the buying rate has to be lower. So, you cannot decide the rate at which you will buy a dollar from the bank, neither can you decide the rate at which you can sell a dollar to the bank. No, the bank will decide. So, the rate set by the bank should be the rate at which you should buy and sell dollars to and from the bank. So, remember, and you can think of it, where the quotation is the direct quotations, where number of local currencies are expressed for 1 unit of foreign currency, selling rate has to be always higher and the buying rate should be always lower. Buying rate should be always lower. And we'll take another examples the other way. Now, to explain the buying and the selling rates along with the direct quotations and indirect quotations, let me take a simple illustration. Now, we'll think of a Swiss company, and then you can decide what the local currency has to be. Since the company is operating in a country like European country Switzerland, we'll take the local currency as the franc, right. I have taken some hypothetical figures. Actual exchange rates can be different, so don't make a fuss out of it, and I want you to understand the concept only. Let's forget about the reality. Don't make a fuss saying that the exchange rate as of today is this, is not this. I have taken wrong figures, so let it to be wrong, no problem. I want you to understand the concept, right. If the local currency is franc, Swiss franc, foreign currency has to be US dollars. Foreign currency has to be US dollars. In my first quotations, what have I done? I have expressed number of francs for one currency, $1. I have denoted number of francs to be exchanged for one single dollar. So, dollar is the foreign currency, francs are the local currencies. I have expressed the number of local currencies to be exchanged for 1 unit of foreign currency. Where you express number of local currencies to be exchanged for 1 unit of foreign currency, it has to be the direct quotation. Direct quotation. Direct quotation. In the second, I have denoted the number of US dollars to be exchanged for 1 unit of franc. Franc is the local currency, dollars are the foreign currencies. Franc is the local currency and the dollars are the foreign currencies. And if you decide to express the number of foreign currencies for 1 unit of local currency, so ladies and gentlemen, the way we learnt it before, it has to be what quotations? Indirect quotation. It has to be indirect quotation. Now, we'll see what the buying and the selling rates should be in direct quotations, indirect quotations. We'll understand the logic, but then you need to remember it. And sometimes you can think and take also, but sometimes if you start thinking, it takes little time at the exam. So, your success is a matter of timing, and you need to try to save your time as much as we can in this examinations environment. So, if you can remember, there is nothing wrong, but in practice, when you do something in practice, you need to understand it. Now, let me take the direct quotations first. Direct. Here, if you walk into a bank, we are in now Switzerland, walk into a bank, and the bank will give you a dollar by accepting how many francs? Bank is doing a business. Always the amount, whatever the currency, no matter what the currency it has to be, so they are into a business and they want to get more. So the bank will decide to transfer $1 by accepting how many francs? 4.75. So this is the selling rate of $1, selling rate of $1. On the other hand, if you walk into a bank and you have $1 with you, you will give the dollar to the bank, you give the dollar to the bank and you take the francs. How many francs do you think the bank will give you? 4.5. For giving $1, the bank will be receiving 4.75 francs, and by receiving $1, the bank will give you 4.5 francs. So the bank will make a profit of 0.25 francs for every exchange transaction of a single dollar. The bank will make a profit. So as a result, as a rule of thumb, you need to remember in a direct quotation, the selling rate has to be always the higher rate. Higher rate is the selling rate. Whereas the lower rate has to be the buying rate. Lower rate is the buying rate. Lower rate is the buying rate. Now let me take the other one. So don't be confused. Say you will walk into a bank still in Switzerland. Not that are we exchanging dollars against francs. Now we are going to exchange francs against dollars. So remember the difference. We are going to exchange francs against dollars. Once again, you need to remember and you need to make it a permanent fixture in your memory. You need to look at it from the bank's viewpoint, and don't ever forget the fact that the bank is doing a business. The bank will do any damn thing. I mean, the bank will decide the rates, not in a way that they want to make the customer to make profits, in a way that they want to make profit for themselves. So you need to look at it from the bank's viewpoint, and then you will see how much we will get and how much we will lose. Now, a customer walks into a bank. Customer, you are the customer in Switzerland. So without you exchanging dollars against francs, we are exchanging francs against dollars. Now you will be giving 1 franc to the bank. If the bank is doing a business by receiving a 1 franc, the bank will try to give you a higher number of dollars or lower number of dollars. The bank will try to give you lower number of dollars. And then, on the other hand, if you walk into a bank in Switzerland, and if you want to take a franc from the bank, the bank is trying to get a lower number of dollars or a higher number of dollars. So that is what you need to keep in your mind permanently, and you need to let it to be rooted deep into your mind. Here, we are exchanging francs against dollars. In my previous one, we were exchanging dollars against francs, and here we are exchanging francs against dollars. I am giving a franc to the bank. And the bank is now giving me how many dollars? It's 0.22 or 0.21. Here, the bank will try to maximize their profit. So their outflow, their payment should be low. And then if you walk into a bank in Switzerland, you are the customer, okay, right, and you take a franc from the bank, you will take a franc from the bank, and then the bank will get US dollars. The bank will try to get the maximum for themselves. The bank will be charging how much? 0.22. Now, if it is an indirect quote, here $0.21 has been sold for 1 franc. Okay, you are given a franc to the bank and the bank has given you just 0.21. So, this is like the bank selling $0.21 for 1 franc, and this has been the selling rate of dollars now. Selling rate of dollars. Here, the bank is giving you a franc by receiving how many dollars? $0.22, and this is going to be the buying rate of dollars now. If it is indirect quotation, remember, indirect quotations, remember, the lower rate has to be the selling rate. Lower rate has to be the selling rate. Lower rate has to be the selling rate. Has to be the selling rate. And the buying rate has to be the higher rate. Buying rate has to be the higher rate, and this has to be solidly concreted in your mind. How successful you are in your future studies depends on how well these basic concepts will be fundamentally rooted deep down in your mind, and you need to, for the God's sake, please, you need to be thorough in this area. If not doing, the calculations in the future will be hard. I am doing some theory because this is important. Without doing theory, let me do a fast forward revisions of the balance part. Certain areas very simple and you need not to spend a lot of time. So, let me repeat it once again. If it is a direct quotation, selling rate has to be higher and the buying rate has to be lower. If it is the indirect quotation, selling rate has to be lower, buying rate has to be high. Higher rate should be the buying rate. Buying rate. Buying rate. And if you can't remember it, just think it from the perspective of the bank, not from your perspective, and then you can decide what rate we will get the currencies, what rate we can sell the currencies at to the bank. So, this is very important. If it is the direct quotation, higher rate should be the selling, lower rate should be the buying. If it is indirect quotation, lower rate has to be always the selling rate, and the higher rate has to be the buying rate in an indirect quotations.